everyone, and welcome to Passive Income Active Wealth Show. I am Bill Fairman, Wendy Sweet over here, and Jonathan Davis all the way in the corner. Well, at the end of the table.
They usually keep me in the corner.
Yeah, you've been a bad boy.
We are Carolina Capital Management. Our website, if you are interested in borrowing money.
When you are interested.
Yes.
All right, I like that better.
Yeah.
CarolinaHardMoney.com. Click on the Apply Now button. If you're an investor looking for passive returns, click on the Investor tab. Don't forget to subscribe, share, like, ring the bell, all that good stuff.
Tell all your friends.
We have a chat feature as well. So if you have any questions, it's either going to be on the side or the bottom of your screen, depending on the platform that you're on. How's everybody today?
Good. And I can tell it's nippy outside. You guys are in such nice little sweatery looking.
Yeah,
I was so
weather.
excited to wear my sweater vest.
I know.
By the way, stop touching us. That's how we got COVID.
No. It was all your fault because you touched all of those things over there and I had to touch it after you.
Why?
I think you had another meeting or something.
Okay.
Was that it?
I just want to say I've been COVID free since 83.
Yeah,
so.
because he's a baby and he never gets anything. It's not fair. Plus, he has kids that have been out and about, and yeah, it's nice to be young. You can fight things easier, I think.
This is true, but yes, it's sweater weather even in the southeast.
Yeah, it feels great
right now. I got up and all the rooftops had frost all over them, and I'm a t-shirt and shorts kind of guy.
But it's nice and a little over 60 now, so it's perfect.
I do have some late fall clothes that I like to wear every now and again.
That still fit. Because he's so thin and in shape now, everything just drapes off of him. That's my boy.
What is it that you
I touched him again.
What is it that you want from me now?
I know. You're not used to me being nice.
She has been extra complimentary today.
I'm just glad to be alive.
Well, we are too.
Stop touching us.
Yeah, I asked God to show me who I needed to love for him today, and I guess it was you. Congratulations.
Thank you. Okay, so guess what? We have economic news, and this would be a good time to do the news of the day.
Oh, yes. Sounds great. This just in.
I feel like we're starting an epic movie.
That's right. Well, it is kind of epic. It's news.
So,
and it's not about politics, so
Wednesday,
that's really good.
on Wednesday, they did the housing starts and permits nationally, and that was really some good news in there. We were up 4% in housing starts from last month. And again, we're approaching winter, so housing starts. That's good this time of the year.
Mm-hmm.
It's unusual,
We're up 20% year over year, which is a big number.
That's incredible.
We're up
how much?
We're up 4% from last month,
and
20% year over year.
That's amazing.
So
that's amazing.
There's a big exodus out of the major metropolitan areas into the suburbs, and builders are now feeling very confident about building homes.
Yeah,
because interest rates are so low. I mean,
still
low. I mean, they're
well over a year, 2 years now.
So
almost.
Yesterday, the 30-year fixed was 2.86%.
Unbelievable.
2.86%.
Yeah, if you're lucky enough to be able to qualify for a conventional loan, but we self-employed people.
I tell you that
you don't get that W-2 income. It's
I know. I love talking about it, but I can't do it.
I'm seeing 30-year fixed rates on, if you're really good credit, but you have a hard time documenting income because you are self-employed.
Yeah.
There's some stuff out there with rates still in the low 4s
for
that non-QM loans too. So that's
non-QM means
non-qualifying.
Yeah.
Mortgage.
And what that means, non-qualifying mortgage, it means it's not Fannie or Freddie or FHA or VA. Okay.
It's not a true conventional loan.
No.
It's not a
government backed loan.
They're using alternative documentation to prove. You still, thanks to Dodd-Frank, you still have to prove that you have the income to support the payments. In this case, they do it with 24-month bank statements for business and personal, and they look at the cash flow and they make sure that you don't have to. They do your debt to income ratio based off of cash flow.
Yeah.
Mhm.
Are they using your
So
business
it's
cash
not-
flow too?
Yeah, well, if it's your business.
Yeah.
The good news there is it's not a no doc loan. It's an alternative documentation loan. So they're still proving that you can make your payments comfortably.
Beyond fogging a mirror, you have to do a few things.
Yeah, and then the other half of that housing starts is that building permits were up substantially as well.
Yeah.
So not only are they building, but they're planning to build.
And
even
that's
more.
what's so crazy too, because, lumber is more than double what it was really just a few months ago.
Yeah.
Sheetrock is up, cabinets. I don't know that the pricing is up, but the length of time that it takes to get cabinets and windows now is kind of like ridiculous.
Yep.
Well,
I'm amazed at that costs are up so much, but they're still just building.
I had to get a couple custom order windows. It only took me 2 weeks to get them. So
Well, that's not bad.
I thought I was going to be 3 or 4 weeks. So.
Yeah, that's not bad. Awesome.
well, you have to look at it this way: supply and demand. How many times did we have landfalling hurricanes this year in the U.S.?
Lots.
I think we had 10.
We had a
Did we
buttload.
not? 8 or 10 of them.
Boy,
So guess what? You're going to need building materials.
yeah.
And then the
same
supply
time-
chain was interrupted for
Yep. At the
that
same
time,
time, you
yeah.
had restrictions on people working. They had to figure out how to bring people together to be able to work
Yeah.
in the same building.
Yeah, and it looks like that may happen again.
You had a lot of people building stuff too because they're
Mhm.
trying to keep up with new construction.
Hmm.
So there's a big demand on those supplies. So that's something to keep up with.
I noticed you misspelled a word on your page.
And it's funny. I was just talking and I got a new T-shirt
Yeah,
that says Spelling Bee Champion, and it's got champion spelled incorrect.
that's good. Don Harris had something on his Facebook post that was really interesting. And, if half the parents had to or had to homeschool their kids, it was a great statement. And all of it was misspelled.
you're like, what's the? I think what the famous one is. Great spellers untie.
Yeah.
Unite, untie. No.
I like that. That's pretty funny.
Yes, that is quite humorous. All right, unemployment numbers.
Dun, 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 dun.
The initial claims are up over what they thought they were going to be. Initial claims were 745,000.
Oh.
They were only expecting 705.
Uh-oh.
But the continuing claims were down. They're in the 6 million range. That's a number that's going to be up and down until we finally get a vaccine that's distributed to the majority of the population.
You think that's going to make the difference, having the vaccine out there?
I think that's going to help, but at the same time, there are industries that are going to be completely, I don't want to say restructured, but it's going to be, there's industries that are going to go away.
Mhm.
And there are going to be companies out there that are going to look around and say,
What's missing?
can we do more with less?
Yeah, we did that.
So they're going to restructure a lot of these different, especially the smaller businesses. They're going to be doing a lot of restructuring. So you have to kind of take note of the industries that
Mhm.
are performing very well right now and are expected to continue to perform well.
Delivery,
And
tech.
Oh yeah.
so it's going to be
Online
logistics.
shopping.
Yeah.
It's going to be anything in home building, remodeling, that type of thing.
And I really
Trades.
like that Jonathan mentioned delivery too. I mean, I'm out in the boondocks because I live on a farm, but and there's not a whole lot of people that will deliver stuff my way.
Well,
But there's new companies out now that are starting to deliver. They're even putting pizza out where we are now. For years you couldn't get a pizza out.
Yeah,
where I am.
but
Yeah.
they're filling that gap. But you have to think of what the margin is going to be for making money doing that last mile delivery
Right.
part.
Right.
And I
So
think
charge me extra. I don't
so.
care.
You can.
Lazy.
There are certain things that drones can deliver out a little bit further, and they can't be very heavy. So it's going to be a selected items.
I'm just
But
waiting.
That's
I
really
think-
kind of cool.
I'm waiting for them to come out with the full like you know, Matrix style where you put in the goggles and you go in like a Ready Player One. I mean, I feel
And
like
shop that
yeah.
way. That's a great idea.
Live that way. Have you
yeah.
seen Ready Player One?
Yeah, I have.
Yeah. It's just
That would be a great idea to shop that way,
Well,
going up and down the aisles.
I know, and you can sort through the
Yeah,
racks.
yeah.
No,
Yeah.
I think that's the way to help save the apparel industry. So you can try the stuff on before you have it shipped.
What is it? The Oculus or whatever that you have that
Uh-huh.
you know online, you know, shopping.
Yeah,
that'd be pretty cool.
I think that'd be way cool. So if we just came up with ideas that people haven't patented already,
Well,
Sorry.
My
I'm
point,
sure we're behind.
my point to these employment numbers is that's going to be shaky for a little while.
Mhm.
So, it's going to be hovering. We're going to have the same amount of people that are out of work and are going to be continued to be out of work because some people are going to go back. Some people are going to get, lose jobs.
Yeah.
And if you're in an industry that is constant, I'm sorry to say this, but hospitality, food service,
Mhm.
uh,
Commercial space.
travel, all this stuff, it's going to be restructured.
Mhm.
So if you're worried about your future, you need to get some training in logistics, learn how to be an electrician, heat and air.
Diversify your income. I
Absolutely.
mean, who's
If
the guy
you're
that
still in
said
the working mode.
Yeah,
Mhm.
yeah.
Yeah.
But even if you're still in the working
Excuse me.
mode, you can still, what is it like? There's ways to use your self-directed IRA with a couple $100, couple $1,000.
Mhm.
There's
Mhm.
ways to do that. So, just diversify different avenues of income for yourself right now, and then also for your retirement.
Mhm.
Well,
Invest in real estate.
yeah, and we talk about that all the time.
Yeah.
You need to have more than one revenue stream because
Yeah.
if that thing goes away, then you're stuck. Even in business, you need to have diversified revenue streams in your business. That doesn't mean you take your eye off of what your main focus
Right.
is.
Right.
As long as you're good at that, then you can always open up new streams of revenue. Just don't take your eye off what got you there.
Right. And
Mhm.
and personally, I mean, we're all doing that too. We have our side gigs. I'm doing rehabs and Airbnbs, and you're doing a bunch of rehabs and buying holds. And
Mhm.
it's, we're trying to personally diversify as well within what we're doing. We're still sticking with what we know.
It's all within the realm of real estate. I mean,
Mhm.
yeah, I mean, I wouldn't diversify over, I don't even know. I would say, stocks and bonds. One, I don't like giving people someone I don't know that control, and I don't understand it well
Yeah.
enough to.
I don't either.
Well, that's I do understand it, but I don't have to I feel like it's more work than real estate.
Yeah,
Like,
it is.
there's people who do like day tradings, and oh my gosh, the amount of work and how much they have to research in those companies. I'm like, I'm not doing that.
Yeah. Yeah.
I'm laughing because you don't want to give somebody control. And ironically, that's what we're asking other people to do when they invest with us.
Yeah,
That's right.
yeah.
But it's okay to do it with us.
We like control. We're really good at it sometimes, most of the time.
Yeah, that's for sure.
Yeah, Scott said you understand it well enough, so
to know you don't want to do it.
exactly.
That
Yeah.
is for sure.
So this is enough banter. This is our Ask an Ugly Question
Session.
So, Scott, ugly. Thank you so much.
A little delayed.
It's okay.
So the first question is, why have you changed your LTV from 65% to 70%? So I assume that's asking us for Carolina our
Yeah.
money.
Yeah.
Why we have, and we just changed
And you wanna
that
explain
last
what-
week.
On Monday, this week. We
Well-
just did it this week. And
You want to explain what LTV and ARV is?
LTV is loan to value. So if your loan is $100,000 and the value of your property is $100,000, that is 100% loan to value. If your loan is 80,000 and your value is 100, then that's 80% loan to value. So Very simple. ARV runs the same way. It's just whatever your loan is to the future value of the property, given that there's a rehab component. So if you bought the house for $50,000, you have a $50,000 budget, your loan amount, let's just say you got 100% financing, your loan amount's 100,000, but the property will be worth 200 when you're done. That's a 50% ARV.
And that's a deal if you can find that.
Yeah, and so-
find those. Yeah.
There's some out there like
And
that.
so ARV stands for after repair value. And what you're buying the house for now is the as is value versus the after repair value.
Mhm.
Right.
We don't have any acronyms for.
No,
as is.
and everything we do, we base it on the after repaired value. And especially after we're just sitting here talking about the economy. And I think off camera, we were talking about, I heard somebody tell me yesterday that Deutsche Bank announced that they thought we were going to have a 20% inflation over the next 4 months, which I think is kind of insane, but who knows, you know.
Well, we could be close to 20% if they take out food and energy and the stuff we actually use.
Yeah.
That's what they've been, the core inflation doesn't use stuff that goes up and down.
Yeah. So why would we, the virus seems to be having a comeback. So we might have shutdowns again. And,
Mhm.
Why would we lend more money? And there's many reasons for this, that we're doing that. Number one is we've changed some of the other things that we're doing when we lend the money. The first one is we are lending a percentage of the purchase price. We're used to do 100% of the purchase price, but now we're doing 90%. So our
Or less.
borrowers are
Yeah.
coming to the table
Mhm.
with 10% of whatever that purchase price is as a down payment. So that's one reason, because they have a little bit more money in the game.
Mhm.
The other thing is we are lending on lower valued homes. We're out of the high-end business. We're sticking in a recession resistant area, which we think is an affordable home market. We changed that back in January of 2019, and boy, am I grateful we did that. Right?
Yep.
It changed everything for us. And people thought we were crazy when we did that back in 2019, because there were plenty of homes that are worth over $500,000 that were selling like hotcakes. But
Well, we that month we decided to not do high-end homes, and we also Wendy and I decided to be the only loan officers for the company,
Mhm.
and that was the best year that we
had.
that we ever had.
Absolutely.
Yeah.
Absolutely.
Yeah.
We kicked butt, but we also obviously have a confidence in market values going forward.
Mhm.
Somewhat of confidence, who can really have full blown confidence in market values?
Yeah, I was going to say right after the first lockdown, no one really has a crystal ball, but
Right.
no one had any idea what was going to happen with housing, and we had to make sure that there was enough cushion and still do business.
Right.
Mhm.
We stayed open.
And now, seeing the demographic changes, we just feel a lot more comfortable with increasing in values in most areas that we lend in.
Mhm. Great point too. Our market that we're lending in.
Yeah, I mean, you're seeing, I won't go as far as saying exodus, but whatever is just short of an exodus of people.
You can use that. That's what I'm saying.
Yeah, of people, leaving the, certain areas and coming to the southeast. We're seeing a lot of that new construction. I mean, it's always easier to, look back and oh yeah, that makes sense. I mean, before COVID, we had over a 3 million unit housing shortage in America. That never changed. But because of COVID, it actually increased it, because
Mhm.
now you have, and couple that with the really low interest rates, people can afford to leave.
Mm.
People are incentivized to leave high rent areas to become homeowners in other areas.
Right.
So, the perfect storm has led to this. I mean, maybe someone's out there who said, oh yeah, I saw this coming. And I mean, I think there's a lot of us who hoped for it, but I don't think anyone could have said, this is
Yeah.
what's going to happen.
Yeah. Yeah.
And truly, the only obstacles for first time home buyers is down payment.
Yeah.
And if they lived in a high cost area of the country and they want to move, the biggest thing is I've been spending all my money on rent
Mm-hmm.
and cost of living and taxes and everything else. It's hard to gather that down payment.
Yeah.
So,
And to further just go in, like, why did we decide to go to that 70? I mean, another aspect that we changed was our loan terms. We used to do 12 months. Now they're more 6 months.
Or
So-
9.
or
depending
9,
on what you're
depending
doing.
on your rehab level. And we're actually doing, we are doing new construction, but we do a lot of like fixed to rents that
Mhm.
require less rehab.
Mhm.
So when you're required less rehab, it's way easier to determine the ARV, but you don't have more dollars going into the project, which means that the value isn't going up as far. So we can lend a little bit more with a little more certainty of what the value is going to be.
Mhm.
The speculation
point.
comes in when I'm putting, all this money in, like, let's say $100,000 into this rehab, and I expect to create 180,000 of value with it, or 200,000 of value with it. It's easier to say I'm putting 30,000 rehab in and I'm creating 45,000 of
Mhm.
value, or
Mhm.
50,000 of value.
well,
That's a more of a sure value add that we can.
Mhm.
but see, on top of that, it's not just the amount and then hoping to get that, but it's also the time that it takes. So
Exactly. Yep.
the smaller ones are going to take less time. So the market is still going to be where it was when you started the project.
Exactly.
Mhm.
6 months. We know. I mean,
We can see that far in
yeah,
advance.
barring a black swan event. I mean, we know
Yeah.
what's typically going to happen. Interest rates don't significantly change in 6 months.
Right.
Mhm.
And so the larger projects, they're going to take longer. There's going to be obstacles to overcome because
Mhm.
there's obstacles to overcome in every single rehab. I don't care if
Yeah.
it's $10 or if it's 180,000.
Yeah. And we keep throwing out the time frame here. The 6 months as a term for a fix and flip rehab. We're doing 12 months on new construction, and really that's not even necessary for most new construction. But time is what keeps people from making the profit on their house, right?
Yep.
They are always, what is your fix and flip
That's
rent
Don,
loan?
no, Don had a question. What's your exit strategy?
Oh
for
yeah,
fix
we'll
and
we'll
flip?
hit that in a
Fixed
second.
to
That's a
rent.
good one.
Fixed to rent, yeah,
That's a
sorry.
good one. So time is what kills most people. They, we love that you're paying us really high interest rates. We love those payments coming in.
That's not the point of it. Yeah.
What we would rather
Yeah.
see is you be able to get out of it so that you can make the profit that you want to make. And so many people that don't make the profit that they're projecting, it's because they were in the project for too long.
Yeah.
Oh yeah. I mean, that almost every project, barring a few anomalies that or structural issues that were not foreseen, most people either don't make money or lose money, like you said, because
Right.
of timing.
Right.
Very few. I mean, I would say less than 2% that I see is because of a structural issue that wasn't caught up front.
Right.
Most
right,
of it is you took too long.
Right.
You lost, whether it was your fault as not managing the project, or your GC walked out on you, or
Mhm.
whatever it was.
And that all will happen,
yeah,
right?
it all, yeah.
It'll all happen. I
Yeah.
promise. I promise. So let's answer Don's question. What is your fix to rent loan exit strategy? We actually have a new program that we are about to put out. We've been saying it for months, but it's finally on paper and in our computer now. And to be truthful with you, I'm going to put my loans through first to see how difficult it is to get through this company, because it's not a product that we keep. We're actually doing it with a larger lender. The larger lenders actually who's backing it. They have, I don't know, $800-900 million in the bank, so they're a little bigger than us. Just a little.
Yes, we are partnering
Yeah, that's a good way to
with
say
another
it.
lender to
Yeah.
do the longer term stuff.
Yeah. So I want to do my own, one or two of my own first, just to see what kind of issues we run through to get it done. And then we'll start doing it for everybody else. But, we're certainly not the only game in town. I know Vizio does long-term, what?
Scott.
What?
I'm not sure why that's up there.
Okay. He hit the wrong button.
That's okay.
But we He's next. He's coming up next.
He'll
Mike
be on the
Moulton
next
is.
show.
Yeah.
Yes, sir.
But we are, there he goes. That's a good guy. But
We like to do promotions for our next show.
that's right. So Michael Moulton, I was getting ready to say, no. Vizio Lending, I know, is doing some longer term finance options. I think Civic might have a program out there. Lima One has a longer term program out there.
Yeah. I mean, and
our short answer is the exit strategy is refinancing out of our
yeah,
loans.
that's exactly right.
And how do you refinance out? Most of them, I would say most of them have a 1.2 DSCR, which is debt service coverage ratio. I think we've talked about this before. You know, your principal and interest payment on the new loan that you're getting, plus your taxes and your insurance, have to be at a certain level. Like the income on the property usually has to be 20% higher than your principal, interest, taxes, and insurance.
So if that payment was $1,000, you're going to have a lease for $1,200 a month.
Yeah.
Or $1,250 a month,
Yeah.
whatever they've got that
because
set up
they
on.
don't want you just to be able to make the payments. They want you to make a living too. Because
Right.
if you're not making any money on these things, what incentive do you have to keep the pain in the rear end rental
That's
property?
exactly right. And the rates are all over the place. I mean, I'm seeing the ones that we are going to be offering will be 7.5 will be like the lowest opportunity for you to get an interest rate. And you've got to have, I think the credit score was a 640 or a 740 or a 750 to get that that higher interest rate. So they're going to run between 7.5 and 8.75 is what I'm seeing on things like that. And and then your loan to values are not what they once were. They're going up to 70%, 75%. If you want to get up into the 80 or 85% range, you really need to be talking to a small local bank in your area. If you can qualify with them, that is absolutely the best way to go. First and foremost, always the best way to go. They're going to give you the best rates. They're going to give you the highest loan to value. They're also,
but they're going to take the longest, and you're going to have
you're
going to have to give them the most stuff.
Yeah, that's true. I mean, there's definitely a trade out, but for that difference of rate, it's worth it because they're going to be in the 4.5-5% interest rate.
But they're also going to be on a 20-year AM.
Yeah. And it might be renewable every 5 years. So when you're going to your local bank, you need to make sure that you're asking for the commercial mortgage lender, not a regular home mortgage, residential mortgage lender. You want to be talking to their commercial guy because you want to be able to keep this in your LLC and that kind of thing.
Well, and it's all trade-offs is what you're looking for. I mean, at a local bank, you can probably get 4.25, 4.5, something like that, but it's going to be on a 20-year AM. And if you can get a 6 or 7% rate on a 30-year AM, those payments look the same.
Yeah, that's true.
So it's kind of what works for you in that moment for that property. Yeah.
And keep in mind, if let's say you're paying 7 to 9%, that's really only going to work on your smaller dollar properties.
Right.
And if you're buying them properly because you're getting them at a discount, you're fixing them up. As long as you're buying them low enough, you should be able to make enough of a return to make it worth your while.
That's exactly right.
That's good. On the new program that you're working on, what's the minimum loan amount?
The minimum loan amount is $50,000.
Yeah,
which is really unusual because most of them are at 100.
Most of them are 75 or 100.
And I can tell you that a bank is not going to do anything below 75,000.
Yeah. So 50 allows
their while.
50 allows you to buy what we like, those high income producing properties, and still make the 7 to 9% payment, and it's an easier process.
Yeah.
It doesn't work on a $400,000 rental. It just doesn't.
Right. Which a $400,000 rental's tough. I don't care where you are.
That's pretty tough. Yeah.
In fact, we were talking about
unless you're in California.
Yeah. Well, I've got a friend. He's
that's why they're moving here.
He's got he went with us to Africa. I was talking with him yesterday. He lives in Seattle, and he said he just had to buy a house. It's a 2-bedroom, 2-bath house. He had to buy it because rent for a 2-bedroom, 2-bath was $2,700 a month. if you're in Seattle. That's
Wow.
what he's paying. And it saved him almost half being able to buy a house there. So, that's kind
That's
of crazy,
insane.
kind of crazy. But we don't have those kind of rents around here.
Yeah, he could just pitch a tent downtown. And
Yeah,
get free rent.
Yeah,
there.
yeah. And he's living in Seattle, but guess where he buys property?
North
To buy
Carolina.
and hold, South Carolina.
Okay.
Yeah.
Close
Yeah,
enough.
he has some in Charlotte too, I should say, but he's
South Carolina is one of the top 5 states with, population, we'd say growth, but, migration.
yeah,
Yeah.
we're good.
Yeah. Greenville, Columbia are two of the
Hot spots.
Mhm.
Nobody come to Rock Hill because Rock Hill there's nothing going on.
Nothing to see here.
folks.
Nothing to see here.
I'll tell you another area that's really popped up that surprised me is Lancaster and Chester. If you're looking for rental properties, those are great areas to hit. Great areas to hit. And I used to tell people to run like the wind, when they were looking at property there. But
Well,
they're
typically that was for your fix and flip. And
Yeah.
They just weren't. They wouldn't move fast enough.
Yeah.
But it's a great rental.
Yeah, it is a
Wow.
great rental. But Lancaster is becoming a really good buy and hold because people from Charlotte are moving out
Yeah.
toward that Lancaster. And that's what you're going to see across the country is all of these major cities. You need to be investing in the second tier cities that feed those major cities because that's where people are moving to.
Yeah. The biggest thing was commuting daily into the bigger city. Well, you don't have to commute daily now.
Yeah. Hey,
You
that's
can-
a great
You
point.
can
though.
work,
Yeah.
3 days a week at your house and
hmm
2 days a week in the office.
That's
Yep.
right.
You don't have to do that daily commute. So yes, you can afford to be out further.
Yeah. Yeah. And you need that second office space so you don't have all the
Yeah. You need to have a
homeschool
bigger
kids.
house.
You're experiencing that, aren't you?
Yeah.
That's tough. That's really tough. There's a lot going on at home these days. So the electric companies and the gas companies are making good money because I'm sure we're using a lot more.
Well, you
with
saw that.
everybody
What was
being
it?
home.
Right after COVID, I think, wasn't it? Warren Buffett, didn't he bought some natural gas company, or Berkshire Hathaway did, but yeah.
Did he
Oh,
really?
yeah, they
Okay, so
invest-
whatever he does, I'm doing.
Yeah, they invested like $7 or $8 billion in buying. I can't remember which one it was, but it was in the Southeast.
Yeah, he's made a
Yeah.
good decision or two in his life.
Yeah.
So
Yeah, it's
I
funny.
would-
He sold a very large piece of Apple. He had a lot of money in Apple, and people were saying, "Wow, he's selling Apple. It means it's going down." No, after he sold a bunch of his shares in Apple, he still had the same dollar amount he started with because Apple went up so high.
That's funny.
he
So
just
he's-
needed cash to buy all
he's
that.
just
natural
diversifying his
gas.
holdings. That's all.
He is, and that's what that's how everybody should be looking at it too. So
Mm.
we are at 12:40, so we probably need to get to this next question.
All right. So, what is risk tolerance, and why should I care about it?
Hmm.
What are you looking at me?
Yeah,
well,
Bill.
that's kind of you. That's on the lender side of life.
It's actually
Well,
on everything.
Yeah, that's true.
The
That's
risk
really true.
tolerance that we have for making a loan.
Yeah.
And then the risk tolerance for an investor.
Yeah, into a
on what they
fund
want.
or a one-off.
So let's talk about investing first, since they were all staring at me.
You complained last time I talked to you.
That's
much,
right.
So
He did. There you go.
In most cases, your risk tolerance is going to be age related. And why is that?
well,
Well-
as you get older, you live less, right?
Yeah, and and your stress is so much higher.
I don't know.
You're
None
gonna
of
put your
that's
eye
true.
out.
Yeah.
So, as you get older, you're going to be more concerned about capital preservation than higher yields.
Mm,
When you're younger, you can afford to take more risk because you have plenty of time to make up for it if
Yeah.
it doesn't happen.
Yeah, and
Right?
most of us have
Normally.
to, because most of us don't start out with $1 million in the bank.
I know I didn't.
Yeah, so it's like, all right, well, we got to build something here.
Yeah.
Well,
Yeah.
The other thing is, which is a shame, that most people don't really start their retirement
Mm,
accounts, except for, if they're with a company that has a 401k, they're putting in the minimum because, frankly, when you're really young, you're using most of your money to live on anyway.
mhm.
But if people really had a good retirement strategy when they're younger, It's amazing how much that adds up over time. But for the vast majority of people, when they start to reach their 50s, they're like, oh crap, I guess I should have saved for some retirement.
Yeah. Yeah.
So those people, and I'm saying age related, those people are behind the 8 ball, and they kind of have to
Right.
take a higher risk than they normally would.
Yep.
Fortunately, the rules allow you to put more money aside once
When
you
you're
turn
older.
50 than you do when you're under 50. So they allow you to do what's called a catch up. It's still taking money out of your pocket and putting it in.
Right.
But let's talk about risk tolerance for lending.
Well, before we do that, let's answer this question.
Oh, I didn't see
If
that.
I invest with you all, am I picking individual deals to participate in or purchasing into a larger fund?
It's a great question, Don.
It depends.
If you're an accredited investor and you're putting it in the fund, you have no control whatsoever, and that's what we were talking about earlier with making sure that you understand the management and what it is that they're investing in, because they have control over your money. The benefit of being in a fund is diversification across the entire fund, and that there's guardrails in place. There's in our particular fund, because we're a lending fund, we have loan loss reserves. We're as part of the expenses of the fund, you're setting a certain amount of money aside in case there's losses. So your yields aren't going to do this, as you have to take stuff back, and
Right.
you may have to have a loss in there.
There's typically higher principal preservation insulated inside of the fund.
Right.
So you're generally not going to get the same return each month, but in the long run, it ends up washing, because when you're in a fund, your money's always working. When you're doing individual loans, if you're not an accredited investor, you don't really have any choice.
Right.
You're going to get higher yields, but the high yield comes at a cost, because typically the higher yield loans are going to be the shorter terms, which means the loans are going to pay off.
Yeah. And then
you're going to have to get it reinvested. And if there's, let me give you an example. If you have an 11% interest rate and you miss 1 month out of the 12 months invested, your interest rate's going to be 10.
Well,
if you miss 2 months, it's going to be 9.5. Right? So don't get too concerned with the return in a fund, because it's always happening.
Right.
And there's a lot less work involved. If you want a second job, and it depends. If you're doing it yourself, it's a second job.
Right.
If you're doing it with a managed company, like a company that buys and sells notes, and they'll help you buy and sell notes, that's managed. A company like ours, where we'll offer
pieces of our
individual
deals.
loans. The thing about it is, with an individual loan, while you have a little bit more control, because you get to pick and choose which one you want, you're also putting a chunk of change into one asset.
Right.
And
it's not diversified.
It's not as safe.
Right.
And while the initial yield looks good, the possibility of having gaps will bring your annualized return down.
Yeah.
I hope that helps.
So you need a little bit higher risk tolerance to do what we refer to as one-off lending. Than you do to put into a fund.
Right.
Which is, you're a member of the LLC of the fund, and you own everything that's in the fund. You're
a piece of everything.
Yeah, you got a piece of it, of everything that's in there. So that was a great question. Thank you for asking that.
Yeah, if you're doing the direct lending, you're the big fish in the small pond.
Yeah.
If you're in the fund, you're a small fish in a big pond.
Yeah.
But that's okay. That's why they have schools for safety.
That's right.
But it's all like, I think Bill said this before, and it's all about return on effort. I mean, if you don't have the time or don't want to take the time, your return on effort in the fund, even though the yield may be lower than as a one-off, your return on effort is higher in the fund than it is as a one-off lender.
Yeah. At the same time, you still have to do your due diligence. You have to do your due diligence on the management and what it is they're investing with, and do they have a track record, and getting referrals from other fund investors, and how long they've been doing this for.
Yeah.
So anyway, you're welcome, Don.
Yeah.
And we do know, I mean, we've got people that invest in our fund and they also do some one-off stuff. So they have the option for both. To me, those are people that just enjoy the game.
Yeah.
And they have the time. Yeah. They're all, those people who do it. I mean, most of them are retired.
Yeah.
They're just, there's a few that aren't, but
Yeah.
like you said, they
enjoy the game. They,
Uh-huh.
they want to, they like that action, and they enjoy doing what it takes to get loans out there. And then, we've got some people who love that game too, but they're done with it. And they
Right,
just
so-
want to give us the money and go.
Let's move it along.
And we're talking about risk tolerance.
Yes, I know. Let's
Okay,
talk
what else
about
do you
the
wanna say?
borrowing side?
Oh.
The lending side. If we're looking at a deal, what does risk tolerance mean for us as a lender
Mhm.
when we're looking at a deal?
Yeah, I mean, it really comes down to the 5 C's of credit. I mean, that's really, what's the collateral? What's the person's character? What are the conditions of the market that we're in right now?
Two more.
Was it cash flow? Or I guess capital. Cash flow, capital.
Don't forget about character.
Well, I already said character.
Okay.
There's one
But
more.
we really
Say it
like
again
that
because I
one.
forget.
Basically, we have a lot of guidelines in place.
Yeah.
Number one for us, we look at every deal as if we have to take it back tomorrow. That's our number one thing that we're looking at. How long will we have to sit on this property, or can we get rent for this property if we have to take it back tomorrow? We're looking
Yeah.
at everything that way.
I mean, our last 2, I mean, not to get too specific, but our last 2 months, the average loan size that we funded
Mm-hmm.
was in the 120s.
Yeah, we love that.
I mean, you can rent that all day long. I
Absolutely.
mean, that's very rentable. And that's how we look at things. Our average loan size isn't $500,000. You can't rent those.
Yeah, that's for
you
sure.
can, but you won't make any money.
No.
Yeah. So our risk, as far as risk tolerance goes, ours is low.
Yeah.
That's why we're in the single family affordable housing market. We want to keep our risk as low as possible.
Mhm.
We want to have as much of a plan B, plan C as
Mhm.
possible.
Yeah.
Mm-hmm.
Now,
Now-
do we lend in the multifamily and the commercial
All
space?
day long.
Yeah, we do.
But those are low risk as well.
well,
Mhm.
they can be
Because-
if you underwrite them correctly.
Right.
Which
But-
we
but
hope
you-
we are.
But you have multiple doors that you have possible income
Right.
from.
Sure.
If you ever had to take them back,
Mhm.
and
Sure.
that's kind of the same thing.
But the risk tolerance also comes into how we don't do 80% commercial.
Right.
Right.
We don't skew it to one side. We do typically 70% single family, 30% commercial, multifamily, small balance commercial, stuff like that. So the majority of our bucket is in single family,
Mhm.
in the very safe vanilla stuff.
Mhm.
And now we do other things that have a different risk profile that can produce higher yields to help boost this 70.
Mhm.
But the core of what we're doing is right here.
Right.
Yeah.
Right. This is a great question.
Yeah,
that's up
you
there.
has a question, and frankly, her question is: when you're lending, do you prefer an LLC or an LP? Now, I don't know if you're asking as a lender, being the LP or the
She
LLC.
is. That's what she's.
Okay,
I think so.
I can't answer this question for you. I am not an attorney, and I can't tell you.
Yeah. He doesn't even play one on TV.
I can't tell you the difference. However, I know everything that we do is an LLC. But you really should talk to a corporate attorney that can give you the reasons, the benefits of each,
Yeah.
and why.
Yeah. All of mine, I mean, again, I can't tell you which, but everything I do is in an LLC.
That when you borrow.
When I lend
Okay.
or when I borrow,
Okay.
everything is in an LLC.
Yeah. I do that too. When I lend, if I lend out, I'm going to lend out in an LLC, but I also have done personal as well, just in my name. And I know several people that do lend out just in their personal name. I think the majority of people who are lending out in their personal name, the biggest concern is they want some sort of veil of protection in front of their name, so people aren't always tracking them down asking for money. It might be that you know.
Well,
Well,
some
and then
legal
also
things.
if something, I mean, from my, again, I'm not an attorney. If I have to take the property back, I prefer the LLC to own it,
Mhm.
and the LLC
a
is
good
not
point.
me. And if there's a slip and fall, there's what, whatever happens on that property, Jonathan Davis, won't give you my middle name because we're not that close yet, but I'm not personally liable
Right.
for that. The LLC is.
Right.
yeah, the only way you would be personally liable is if there was negligence involved,
Mhm.
and they can prove that.
Yeah.
That said, there's not anybody can go to the Secretary of State of wherever that LLC is. Of course, you'd have to figure out where it is first,
Yeah.
and then you can find out who the principals are. The only way you're going to have real anonymity, and you can still break that veil
Mhm.
with a lot of work, have to take people to court, and it's going to cost a lot of money. And this is why
Mhm.
people choose it, is a trust, a land trust of some sort. And but the corporate liability veil is really the most important, not necessarily your personal name, because people can find it
Yeah.
if they work hard enough.
Yeah. And you can pay just, you don't have to even set up a trust, but you can just pay a third party to set up your LLC, so it gets filed as the person filing, and your name is never on it on the filing. Now,
Right.
Now people can do research and they can request those documents, subpoena, however they want to get it, but they can get it. It just creates another layer.
And by the way, this is all personal opinion. We are not giving legal advice.
Yeah.
Yep.
But you know what we can do is we should invite Mary Hart and
that's a good
maybe
idea.
Quincy Long to come in and
Mhm.
talk about trusts and how they work and the benefits and
Yep.
that kind of thing. That would be great. So we'll put that on our list. I'm going to do it.
We can only
write
tell
it
you
now
what
so I
we've
don't forget.
done. We have LLCs, and
Right.
but
And they
We
were
don't know what you should
recommended
do.
to us by our securities attorneys and
Yeah.
everybody else involved.
Yeah.
So,
Yep.
there's got to be a good reason. For
Yeah.
that.
We figure they know way more than us. So we just say, okay.
is the fund a limited partnership or is it an LLC?
It's an LLC.
Okay.
Mhm.
It's an LLC owned by the investor.
Yeah.
Mhm.
Okay. Listen, it's been, wait a minute.
We got
I got
another
one
one,
more.
Sue. I always enjoy listening to the three of you talk and answer questions. Thank you, Sue. It's a wealth of valuable information. Would love to hear stories from Mary and Quincy. We love Sue. Thank
All
you,
right.
Sue.
So we had to get that in because Sue is tooting our horn.
Yeah, and
So,
Sue
thank
is
you.
actually, I mean, she's been lending with us for like mega years.
She's in the
She was on our show
she's
last week.
she's in the fund, right? She's in the fund.
and she's a one-off lender.
She's a one-off lender. She uses an LLC. She uses her IRAs. If we had her last week, and if you get a chance, you need to pull it up and listen to her talk because it was awesome.
Mhm.
Yes, absolutely. All right. We have other things to do, so we're leaving.
We're hungry.
I'm just kidding. Thank you so much for joining us on Passive Income Active Wealth. We are Carolina Hard Money. No, we're not. We're Carolina Capital Management, but we're also Carolina Hard Money.
Tell
Our
your
website
friends.
Don't
is
tell anyone.
carolinahardmoney.com. If you're a borrower, click on the Apply Now. If you are an investor, click on the Investor tab. Don't forget to share, like, subscribe, ring the bell, all that good stuff. I had a great time, didn't you?
I did.
All right.
It was
Every time
enjoyable
with
for
you.
me.
See you guys later, actually. Bye.
Bye.